Welcome to today's webinar, compiled and produced by the team at biznews.com. All of our webinars are interactive. We encourage you to pose questions to our guests. The more challenging, the better. And the earlier you get the questions in, the better the chance of having them answered. The recording of this webinar will be available later today on the biznews.com channel on YouTube. Indeed, it will be, and I'm Alec Hogg, coming to you here from our studio at BizNews, and of course, as always in the webinars, here's Stuart, our General Manager. Stuart.
Yes, thanks, Alec. Always good to be here. That time of the month again, where we get to see how stocks have moved and what's new and what's not. Nothing leaving this week though, so it's just what's new. Hey?
Yeah, the problem, what's new? A couple of bits new, and the problem, of course, is that you only have it once a month. So we were talking off air a little earlier that when we spoke with Dr. Richard Smith from the Foundation for Cycles in America, he told us, it must have been maybe 3 weeks ago, he was saying that people he's talking to recommend Twitter and Peloton. And I had them all ready to bring into the portfolio, but Twitter's gone up 10% and Peloton 20% since then, which of course pushes them into a different league. So the one thing I'm going to say to everybody today is please listen to the BizNews Power Hour. It's on biznewsradio.com. Very easy. Just stick that into your browser and bookmark it, and you'll be able to pick it up every evening at 5:30. And then we have re-records at 7 in the morning and 7 at night. And it's also on YouTube. So if you subscribe to our BizNews TV on YouTube, you can actually watch what goes on. And boy, last night did we have chaos. What happened was, before the show last night, one of our pieces of tech actually fell out. We're in this temporary studio. We're moving to our new premises.
I'm hoping Friday morning, Alec. But
we're hoping this week, where we've got a proper studio. But anyway, we're in this temporary studio that has served us well for the last 3 months. We've been doing live broadcasting from it, and we're coming to you from it today as well. But it has its limitations, and if something goes wrong, it's like pieces of sticky tape that have been put together. And we had one of those sticky tape nights last night. Nevertheless, we came through it, and I would recommend that you, if you want to have a well, we didn't publish the YouTube video. No, not that one. But it was a bit of a circus. But anyway, it's great fun. We have our guests in our virtual channel, and you can pick up on that. Anyway, enough blathering from my side. Stu, let's check that all the tech's good.
Excellent, thanks, Alec. If you've heard Alec and myself speaking now, and you can see the presentation with the welcome back Spotify. Let me just get my camera up as well, and you can see Alec and myself. Can you just give us a high five on the control panel on the right-hand side? Here we go, Alec. Got some high fives coming through. That's excellent. We also like to keep it quite conversational. Once Alec's gone through the initial jokes of the presentation, there is a questions box on that same control panel. If you put them in there, I'll pass them on to Alec as we run through. But Alec, all looks good on the tech side, so I think we're good to go.
Yeah, brilliant. And just to reiterate again that this is interactive, and if you click on that question mark, you can just write in your questions, and Stu will stop me from wherever I am and prompt me to discuss. I see something else that went wrong with our light,
Yes.
studio light. Anyway, so I'm feeling a little dark today, but not. Sorry, I'm looking a little dark today, but not feeling dark at all. So let's get into our portfolio. I'll switch off my camera, and as you can see, compound annual growth rate. Remember, this is now 6.5 years. It's our 6.5 year anniversary. We started in December 2014, and the return compound annual growth rate 21.9% in 6.5 years, or nearly 26% in rand. That's really spectacular. But as I keep telling people about compound annual growth, have a look at Warren Buffett. He's achieved over almost 60 years compound annual growth rates of over 20%. In the Berkshire Hathaway annual report, you'll see he always starts with that, and that's quite extraordinary, the best investor in the world. At the moment, we're doing better, but I think that's largely because It's been our time, hasn't it? It's been the digital era, and it's a sector that we're very concentrated here at BizNews on digital. We're just a digital company. In fact, we have nothing non-digital.
Yeah, sure. Everything we've made the PDF, the newspaper digital. So yeah, everything we digital.
So that's our game. I'm really gutted by having sold Cloudflare last, or when was it, 2 months ago. And it's just a fantastic company. But it did seem at the time that we were getting lots of feedback about emerging stocks being in bubble territory. I looked at them. Cloudflare was trading at 50 times sales, and it just had to come back from there. Well, it did come back a bit, but of course, doing this once every month means that we missed the early 60s on Cloudflare to get back into it. However, as you can see from the headline there, we are going back into Spotify, and there's quite a story to that one too. So I'll explain that as we go along. Right. So the concept really is, I do the presentation, you ask questions as we go along, and Stu just interrupts me. April was an amazing month for this portfolio. It jumped up just about all of our stocks. In fact, 2/3 of our stocks had double-digit growth rates in April. They rose by double digits in April. This month, things have come back a little. You might remember in April, I was a bit concerned about Naspers. I have been now probably for 3 or 4 months saying that Naspers, they're facing headwinds in China. The Chinese government is now starting to get its clause into Tencent, which is the reason why Naspers is what it is. The investing community doesn't like the management of Naspers. They think they spend too much time trying to engineer the share price or reduce the discount between Naspers and Tencent, when actually what they should do, according to the analysts, is just unbundle the Tencent shares. And the problem with Naspers, when it is trading now at a 50% discount to its asset in Tencent, is that if one day sanity prevails and the managers of Naspers do unbundle those shares, the share price will go up 30 to 40%. So you really are stuck in a little bit between a rock and a hard place when you own Naspers shares, because the short-term trajectory doesn't look great, but the long-term, they can transform the valuation of the share overnight. So you're sitting with something that is at a huge discount, and we're just hanging in there, even though, as you can see, went down 8% in the last month. The other big loss there was 2U. The financial results came out. I quite like them. They are cash flow positive. They've got lots of money in the bank, but analysts wanted to see more from 2U. They wanted to see 2U expanding at a more rapid pace, forgetting that you're now comparing the March quarter with March last year. So there's lots of reasons for why you should just ignore these short-term bumps. Similar with Zero, it really is one of the best stocks in the world, I believe, and it's now 125 Aussie dollars. It got to nearly 100 Aussie dollars, and that was in between. And really what the idea is, if you see the share prices of these stocks, and you understand these stocks, you do your research on these stocks, you know that we're doing our research on them, watching them very carefully. If you see the share prices of these stocks tanking, unless there's a fundamental reason, a fundamental difference for it, you can buy with confidence because you've done your homework on it. And look at that in the past month. Discovery up nearly 15% in the month. Nice to see that bounce there. The big loss, of course, I mean, we bought the day before, not the day before, but I think it was 2 days before. Yeah. Tongaat came out with a statement, which I'm going to go into in some detail. I've been watching Tongaat for a long, long time. Of course, I had no idea that that statement was going to come out. Otherwise, I would have said, let's wait for next month, obviously. But those of you who didn't buy in the time that we bought at 10.40 could have picked it up the next day at 8.50 or 8.40, 8.30. Even actually, it went into the 7s at one point. It's sitting at 8.30 now, but we'll discuss that in a moment. I thought Tongaat was so cheap that we broke all the rules and we bought 100% of the allocation of Tongaat at that time. Purple Capital, on the other hand, I was a bit worried about, but we did the 3-way stagger of Purple Capital, and we've now bought the second tranche this time around. Purple's been solid. whereas Tongaat was the one that if we'd broken it into 3, it would have been better. Whatever. These things happen, and they teach you and they remind you to stick with your principles. But as you can see there, in the past month, in rand values, the portfolio was down by nearly 4% more than it was in dollar values. And that's because of the rand's appreciation. The rand at 13.85 today. It was sitting at 14.40 a month ago. So we really are having to offset a very strong rand in this portfolio. However, it's well positioned, and we're taking advantage of the strength of the rand in a way that I'll show you in a moment. The changes that we're doing today, you look in the green part on the screen there. The second tranche of the purchase of Purple Group has been done. That's at another roughly 150,000 rand has been invested there. Slightly higher than the first lot. We bought the first tranche at 125. This is 1.27 rand. So that's done and dusted. We've got another 150,000 rand roughly that we're going to invest next month in Purple Group. We've also decided to purchase Spotify, go back into Spotify. Now, you will recall that we bought Spotify at the bottom of the market in March last year at about 130, 125 actually. Had a lovely run up to 250. I was worried about, in March this year, about the concerns that we were seeing from people like Ray Dalio, who's one of the great investors around the world, who was saying that his bubble index was now flashing red signals for emerging tech. So nothing to do with our core holdings of Apple, Amazon, Microsoft, etc., but it was flashing. So I had a look at the emerging tech stocks and which ones looked to be overvalued. Spotify was one of them, which was sitting at the time on a 5.2 times sales. Well, the results came out, which I really like. Being in the industry, I can see what they're doing on the podcasting front. The progress that Spotify is making is excellent, and we'll talk about that in a moment. And we've now decided to buy back into Spotify. Now, we did sell at R2.50, and we're buying back, $250, and we're buying back at 234. But what's more important there was when we sold, the rand was 14.90 rand, and we're buying back at 13.85. And effectively what that means is we're buying Spotify in rand terms at 14% lower than what we sold at. So if it was a bit expensive when it was 14% higher than the current price, it's not as expensive now. And the results that came out for the first quarter were truly superb. Let's start with Tongaat. There you can see the graph of Tongaat over the past year. And you can also see that we bought just when it looked like things were starting to move in the right direction again. So technical analysts will tell you that that's a very, very dangerous point, because if the share price goes up like that, it either means that if it were to get above, say, 12 rand a share, and those numbers on the left-hand side, I haven't been able to get them absolutely right, but it's 600 cents, 800 cents, 1,000 cents, and 1,200 cents. If it went above 12 rand a share, in other words, got above the price that it traded at in November, then the sky's the limit on this one. So you're looking at that and you're thinking, well, what's coming, the word that was coming out of Zimbabwe is very positive. In fact, we're going to be finding out more about that on Thursday. Don't miss our show on Thursday. We have Mdluli Nkube, the finance minister, on our BizNews Power Hour between 5:30 and 6 this Thursday, following up on what Eddie Cross was telling us a while ago. Zim is off the, it seems to be off the radar for most people at the moment, but there are interesting things happening in the economy, where the cement sales are now at 20 or 30-year records. And remember, Tongaat Hulett has got a huge business in Zimbabwe, which is written down to nothing. In fact, it's a negative at the moment on their income statement. So that's something that got me excited, because although we've been following Tongaat Hulett since doing the interview with Gavin Hudson, the chief executive, as a webinar some months ago. In fact, it was last year, wasn't it?
Last year,
yeah. And it was around 6 or 7 rand. He's a lot. He's an impressive guy, Gavin Hudson, ex-SAB Miller. He's got his hands on the tiller there. He's doing things right. But the thing for me that bothered me was, where was the exponentiality? Because this is an exponential portfolio. And then when you start looking at the Zim story, and this is the kind of stock that you can wake up, a bit like Naspers, you can wake up one morning and they've done the deal with the banks and they've sorted out their debt covenants, and the share price could double easily. So it's one of those. So exponentiality is there with the Zimbabwean side. However, what came out on the 29th of April, and I think our webinar was on the 27th or the 28th. Anyway, it was a couple of days before. In fact, it was the 28th. The very next day, after we'd bought at 10.30 Rand, there was a SENS announcement that completely spooked the market. And this is really, I'm not going to read through it. I don't want to give you death by PowerPoint, but you can see there that in essence, what's happened is that they are negotiating with the banks to reduce that covenant from 8.1 billion, which they need to put on the table for sales, to 6.4 billion. Now, if you think about that, just logically, there is a difference of 1.5 billion Rand. And are the banks going to foreclose and liquidate the company for 1.5 billion Rand after they've already met so much of their obligations? Having worked in banking, that's really dumb. You don't liquidate companies. You lose a heck of a lot of money when you liquidate companies. So but the reason why the market was spooked was because of the possibility that if those negotiations with lenders to restate the covenants are not successful, then the company really could go into liquidation. So you are still talking about a high risk situation, but on the balance of probabilities, I think there's an enormous, there are plenty of assets there, and with Zim coming right, the bankers have got to be looking at that and saying, hang on, these guys are not only going to repay their debt, but they're also going to pay their interest. So that's the reason. But you can understand that some people in the market didn't like that. Moving on to Spotify. As you can see there, we sold in March at $252. We've now rebought at $234. That's only part of the story. The Rand was then 14.90 Rand. It's now 13.85 Rand. So in Rand terms, which is really where we live and it's what we're all about, we're buying it in at 14% less. I've already told you about the rationale and the emerging tech valuations, but we're now buying in on a revenue multiple at a purchase price of 4.8, and that's not far different, not much different, for instance, to Amazon. And Amazon's rock solid. I wouldn't dream of selling Amazon. So at 4.8, Spotify, we know the business. They're moving aggressively into podcasts. Their financial results for the first quarter show they're still exponential, revenue up 22% year on year. The premium subscribers growing 21%. Those are incredible numbers. If you can put that on the table, well, you can have a look at what's happened in this portfolio. 6.5 years, we started at 2 million Rand. It's now worth 10 million Rand. That's at a 25% growth rate. So those are the, we as human beings battle to get our heads around exponentiality, but I think this gives you an understanding of it. They've also launched that Spotify Audience Network. Might not mean much to you, but what it does for people like us who provide podcasts to Spotify, which is where they are getting very aggressive into, is that we can now monetize them in the same way as you can monetize websites through Google. So you don't do anything. You just open up your facility to them and the adverts come in, literally. Maybe not paying the price that you want, but there's an exchange that goes on between potential advertisers. So all of that is very, very positive. And buying it at 14% less than what we paid, or what we sold for, thank you very much. It's in the portfolio. So there we have it. There's our portfolio generally. Overall, the $200,000 we started with a 21% compound annual growth rate in 6.5 years is worth $723,000. And that lets you understand. And what is this compound annual growth rate? I keep banging on about it. It's when you grow from one year to the next, you're making money on the money that you've improved by. And that's why it's Warren Buffett calls it the 8th wonder of the world, compound growth. The idea is just don't lose money. And if you can make 20% a year, the numbers grow very, very quickly. And as you can see, Our biggest holding there, which we haven't touched, is Amazon. 22% of the portfolio. Apple's got 18%. I'm very excited about Apple. Being BizNews premium subscribers, all of you, you will have read, I hope, this week in the newsletter what Apple is doing in the motor vehicle industry, how they're moving in there, because cars are becoming iPhones with a body, really. Yeah. That's the way it's been described there. It's a software game now. It's not making engines anymore, because the electric engine is relatively simple compared with the internal combustion engine. We know it's all moving that way. So it's all to do with batteries and engines. That's easy enough, as Elon Musk has shown. The real story now is software. How does the software go in there? And Apple are famously private and secret. They don't tell you anything from Apple. They, from the days of Steve Jobs, they don't care about ego and making announcements and having their executives interviewed. What they care about is growing the business. And so they've been hard at work on the motor vehicle side. They've hired some incredibly smart people, headhunted them, poached them, and the little bits that are coming out of Cupertino now is that Apple's getting closer and closer to doing its thing in motor vehicles, which is most likely going to be straight into autonomous vehicles. So not having an electric car, but having an electric car that drives you where you want to go to. So once again, revolutionary. But read that piece on the Wall Street Journal. I referred to it, I think, in yesterday's newsletter. Yeah, read yesterday's newsletter. You can click on that, and you can see the Apple story. It's when that breaks, then the current share price is, I think, going to look pretty attractive, and it still is relatively attractive where we are. Looking down there, the big surprise for me has been Microsoft, which has been a phenomenal performer. But then again, we invested in Microsoft on the automated customer switch when they went to selling month by month instead of annually. Discovery has been a great performer for us, as you can see, even in US, however you want to look at it, US dollar terms, 184%. And part of the reason there was we bought it right at the bottom of the market, 24th of March. There was a lot of concern that medical schemes like the one Discovery runs would be in trouble with COVID. Trying to look past that, and it's really rewarded us well. And you go down the list there with some fantastic returns that we've seen from various companies. Xero come back to zero growth. So if you haven't bought Xero yet, this is not a bad time.
Cool, Alec. Just on Tongaat, Greggy just wants to know, would you buy more at current levels if you didn't?
Yes, definitely.
Okay.
Definitely. At the at 10 Rand 40, I think it's very, very good value. At 8 Rand 30, it's got to be even better value. I love Piet Villion's view on this. He says once you do your homework on something, it's like when the share price goes down, it's like wacky Wednesdays at Steers, where you're happy to pay whatever it is for one hamburger, but now you get two for the price of one. So you say, oh no, don't want to buy two hamburgers now. I don't want to buy any hamburgers. That's my view. And the same with 2U. I think that's a wonderful, wonderful opportunity, helped along by the decline in the price of the rand. Love Purple Capital. That's a goodie for us. Wilson Bailey, well, it's still a bet on Cyril Ramaphosa's infrastructure plan coming through. It's probably going to happen, but it takes a lot longer than what everybody thought. But I'm very glad to have Spotify back in the portfolio because both Spotify and Netflix are bets on this massive transformation in media from media consumption by appointment to media consumption on demand. And what that means is, although you guys are here in the webinar and you know, it's at 12 o'clock on the last Tuesday of the month, and you're seeing it live and you're engaging with us live, but by far the majority of the people who are going to see this webinar will watch the recording. So it's at a time that can work for them rather than one that works for us. Of course, the advantage of being here live, is that you can ask questions. So please do.
Thanks, Alec. You mentioned WBHO. Charles wants to know, they were mentioned in the Bowman report on Eskom and the Guptas. Must we sell them before government blacklists them? I'm not sure if you've seen that report. But...
No. I know the guys at WBHO, and it would surprise me if they were doing anything even remotely dodgy. They just don't work like that. They don't have to work like that. And I haven't seen that report. I haven't read what's in the report. If Wilson Bailey are named in the report, it might be going back to what had happened a long time ago with the building of the stadiums. There are two sides to that story as well. At the time, you know, we forget 2010, the government wanted to build stadiums, and they said, please just help us, bail us out. If you recall, in 4 years prior to that, I think it was in Brazil where they battled, they got the last bits of building in the stadiums just before the kickoff. With South Africa, because of the collaboration between the construction companies, our stadiums were ready months before kickoff. There was a lot of negative sentiment towards South Africa. You know, Africa can't manage it, and let's take it to Australia, and they're not going to get it ready. We forget these things. That's 11 years ago. And then after that, after they were basically told to work together, they then get hammered by the Competition Commission for working together. That's politics. I don't know what's going on with the latest thing, but it would surprise me no end because they just don't do business that way.
Thanks, Alec. Peter just wants to know, is Spotify once-off or tranches purchase?
It's a one-off purchase, Peter, and the reason for that is that we sold it at a 14% higher price. So all we're doing is replacing it in the portfolio at a 14% discount. You can, and maybe given what happened at Tongaat, you can stagger it, but I've got a feeling here that if you were to stagger it, given that the Rand is very strong at 13.85, and given that Spotify's share price is pretty low, it's been lower, it's got around 220, even lower than that, but that's the luxury we don't have here, is to be able to buy it at the low. But I would say, Peter, that at 13.85 and at 234, you're not going to get Spotify at a better opportunity as a South African buyer. If you're an American buyer, you would buy it over three, no problem, over three tranches. But who knows where the Rand's going to be in 2 months' time? You know, all that happens is it just goes back to where it was last month at 14.40, and you're now on the back foot.
Thanks, Alec. A follow-up from Peter says, is Afrimat not a better buyer than WBHO with their acquisition of a manganese mine?
Yeah, Afrimat's it's funny, when we bought WBHO, those of you who recall, we had three stocks we were looking at: Afrimat, Italtile, and WBHO. And had we bought either Afrimat or Italtile, we'd have been sitting in a very much stronger position there. But we didn't. We went with WBHO because it is the blue chip. Those two are excellent businesses as well. And if it's an either or, I would suggest maybe buy both of them, buy half of both of them. But it's very, very difficult to make that kind of a bet. All I do in these cases is the Warren Buffett principle. He says, if someone walks into a room, you don't need to know if they're 310 or 320 pounds to know they're fat. And that's what we're doing here with Wilson Bailey. Wilson Bailey is fat when you consider the value of its Australian operation, and which is more than 50% of the revenues, and the operations they have in the UK, and of course the high gearing towards the South African infrastructure program. So when I look at Wilson Bailey, to me, although they might have a few months of bumping around, the longer term potential of a company where you're investing in human potential, which is what you're doing with Wilson Bailey, is always superior to that where you're investing in minerals, which is the story with Afrimat. But if you like Afrimat, why not go half on each?
Thanks, Alec. Gavin and Peter, just a question on Naspers. They want to know, would you still tender process for Naspers in the third quarter when a decision has to be made?
100%, absolutely, definitely. There's no question. I buy what the management have said, and I know a lot of people don't. But I listened carefully to the hour or so of Bob van Dijk and Basil Skordos, and really the thing that stuck with me was that you've got Naspers shares which are at a discount of say 50%, and you've got Prosus shares which are at a discount of 30%. That is to the 10-cent, because 10-cent really determines those share prices. Now, why wouldn't you take shares that are at a 50% discount and convert them into others that are at a 30% discount? It's just that basic and simple. You're able in one fell swoop to swap your shares across and to cut that discount from 50 to 30%. And that's what Naspers is all about. So yes, I would.
Excellent. Andrew just wants to know, do you advise selling off staggered like you buy staggered?
No, Andrew, we don't sell often. If you were to go back those 6.5 years, definitely less than 10 sales. And of those 10, we made 3 of them in March this year, which was triggered by the concern that Ray Dalio was expressing on emerging stock bubbles. As it happens, you look back at it and you think, well, maybe he's talking about other emerging stocks, not the ones that we had in our portfolio. But it is what it is, and we go forward now on the basis that every stock in this portfolio is held forever.
Jeremy just wants to know, which shares in the portfolio do you think are still worthwhile getting at today's valuations?
All of them. I would not hesitate. It's funny, I was actually playing around with an idea which we haven't finalized yet, but the portfolio will turn 7 in December. And for a lot of new investors, 7 years is a long time. So for people who are coming into the portfolio now, they look at this and they think, well, you've had 1,000 to 10 bagger with Amazon, you've had Apple and Microsoft giving you, and Discovery giving you phenomenal returns. Should I have less of them or not? So what I was thinking was actually closing out the portfolio in December after 7 years. We park it one side and start a new one. So I've done quite a lot of homework on that one. I can assure you that Amazon and Apple would remain our biggest shareholdings. With that, it was 20%, I think, in each of them. And I did quite a lot of work on it, thinking how it could work. But then there would have been, let me just work this out quickly. There were 864, yeah, that's right, 18% in those two, Amazon, Apple, and then 10 stocks of 8% each. So 16%, 16%, those are your bankers, Amazon, Apple, and then another 10 stocks that you would add at 8%. And that's on the cards. Will we do it? It just makes sense that you have to close off the portfolio at some stage, because people coming in now will look at this and think it doesn't make sense to them.
Alec, I know we've had a lot of discussion on the commodity super cycle. Schwab wants to know, would you happen to know why commodities like platinum and rhodium have been falling?
Well, maybe there isn't a super cycle. You know, that's everyone that we've spoken to so far has, and we've had quite a few on the Power Hour who have said to us, be careful, because this is restocking after COVID. And it's a big difference between restocking after COVID and when you're buying into a super cycle with China expanding at 10% GDP per annum. The idea of a super cycle has to come from, and you've had it in the world twice before in our recent times. The one was Japan, when Japan was expanding dramatically to become the second biggest economy in the world. During that period, the commodities went through a very, very strong run, a super cycle. With China, it was a similar thing. But China's growth has now eased back a lot. And who's going to be the next China? The idea was India would be the next China, but India, their democracies have got other challenges. So is it a super cycle? Perhaps they're telling us something.
Thanks, Alec. The idea of restocking, is that similar with inflation? I saw there's a few articles on how inflation will have a big bump. It will average out again post the initial recovery.
Stu, it could be, there are all kinds of theories. Inflation's not good for economies. We know that. So the last thing you want is to say, let inflation come back, and then we can buy gold and we can buy cryptocurrencies and etc. The big thing about this, the way I read it, is that they have created money at an unprecedented rate in the United States. But where's that money gone? The rest of the world said, we want dollars. Give us dollars. We want those dollars. You can create as much as you like at the moment. And the dollar being, the US dollar being the reserve currency of the world, if you, for instance, did it in South Africa and you started running the printing presses, who's going to take the rands off your hand? Not too many people. A bit like what happened with Governor Gono under Robert Mugabe in Zimbabwe. They printed a heck of a lot of Zimbabwe dollars. As anyone who's visited Zimbabwe knows, that you can get, you get 10 billion or 20 billion notes, and nobody wanted them. So you had hyperinflation. In America, if America was any other country, there would be hyperinflation in that currency. But they want the dollars. People around the world, you go to anywhere on our continent, and you offer them a euro or a dollar, they're going to grab the dollar. Yep. You offer them a renminbi or a dollar, they're going to grab the dollar. It is the reserve currency of the world. You can trade on it anywhere in the world. So for the moment, that argument is not as it's not as powerful as you would think. But we've got lots of other issues that it's a highly complex world, and we've seen in the United States, for instance, with the creation of all these new dollars, they've had a housing boom that's skrik for niks. It's been it's extraordinary. There you're finding people are paying above the asking price for houses. It goes back to what happened in 2007, 2006 and 7, when Bob Schiller was warning the world about this inflation in housing. And of course, we had the great financial crisis as a direct result of that. This time around, housing prices have been stimulated by the creation of dollars. But there's no hyperinflation because those dollars have also been sucked up by other people around the world.
Thanks, Alec. Very complex, but Gavin just says thumbs up on the new your point on a new portfolio. He says it'll be a great idea.
Okay, thanks, Gavin. We might even do it earlier.
Jeremy says I hold a number of low-performing stocks like Long for Life, Oceana, Pick and Pay, etc. What's the recommendation? Sell out and switch, or keep and invest new capital into this type of portfolio?
Yeah, it's a very personal decision. What we've done with this portfolio is we have tried to look for exponential shares. In other words, shares that companies that can grow at a rate of 20% plus per annum indefinitely or in the long term. When you look at the kind of companies that you've got in your portfolio, it's near impossible, for instance, for Pick and Pay to grow at 20% a year. Long for Life has had a good rebound because of the threat of delisting or buying out. Now Investec are advising Brian Joffe. There's a really good interview that we had with him on the Power Hour a little while ago to how they can unlock value. But Joffe's now in profit again, because remember, Joffe bought his shares at 4 Rand. I think he put 100 million Rand of his own money in there. But the kind of businesses that are in Long for Life are not exponential businesses. Have a look at them all. There's I like Sorbet, but Sorbet is not going to be an exponential business. Neither is Moorsport. Maybe the guys who do the Velskuns, but that's a tiny part of Long for Life. So on that one, it doesn't really qualify as an exponential business. And where are you going to get that exponentiality from in it? You can get it in Tongaat because of Zimbabwe. You can get it in Wilson Bailey because of the infrastructure spend that South Africa desperately needs. And all the others in this portfolio are very much exponential companies. So I don't know. It depends on lots of things. It depends on your tax base. It depends on what capital gains tax you'd have to pay. But to me, if you're looking at the new world, if you have a seismic shift in society from an era where incremental growth was fine, to an era where it's either exponential or you die. And that's the reality of it. If you're a motor vehicle company, for instance, with internal combustion engines, you are out of business in 2030 or 2040. You're out of business. You're not allowed to sell those cars anymore, because even in China, they won't accept them. So you've got to move dramatically across to doing something that you know nothing about. And you have to start, and of course, they've learned an enormous amount. But when you look at Apple, which is well positioned as a software company to enter a market where the others are trying to transform. You know, human beings, we don't like change, and companies like change even less. That's why so many companies in the S&P 500 don't survive in the long term, why there's such a high turnover. So it's an unusual situation in history that we find ourselves in, where the world is moving from a one system, if you like, to a digital age. And if you're going to participate in the digital age, be sure that you're investing in companies that are in the digital age, or at least know how to do it. There will be some that'll make the transformation, but you are probably better suited to finding those companies in the digital age who are already ahead of the pack, because those who are coming in are going to have to learn everything that those digital natives have already forgotten.
Isn't that classic 40 years ago? If you look at the top 40, there's only a few companies that are in the current top 40, and it's like that cycle that things just turn over, change, or
yeah, those are very important. I think the big issue here is that when you look at Amazon, Apple, Microsoft, Netflix, Spotify, those are companies who have got a very strong hold in a digital market. And there's a wonderful book called The Guerrilla Game, which tells you about this fourth industrial revolution kind of scenario, tech stocks, digital stocks. And the Guerrilla Game says that in this industry, the guerrilla benefits more than in other industries. In other industries, guerrillas tend to get disrupted pretty easily. In the tech industry, the guerrillas don't. The only question that you would have here, and we'll have plenty of advance warning on this, is the Democrats in America don't like this, and they want to introduce 1920 style antitrust against these big tech companies. And there's a lot of reasons for believing that's a good idea, because being this big, what happens with Amazon, and they're in the process now of buying MGM. Now, who else can spend $9 billion, on a Hollywood studio, which is already being threatened by Netflix doing its own movies? I mean, Netflix are going to be spending double what was spent on Game of Thrones, which up to this stage by HBO is by far the most expensive series ever made. They're spending double of that on Tolkien's Lord of the Rings in New Zealand. So it just gives you an understanding of these newcomers. So how does MGM compete with that kind of thing? They're just not in the game. Whereas Amazon says, okay, rather than building another MGM, or rather than building another production house to take on Netflix with Amazon Prime or Amazon Video, they go off and they buy MGM. Who else would buy MGM? Nobody. There aren't others who are in the game for it. We saw when Verizon or AT&T tried to do it when they went and bought Warner Bros. They made an awful hash of it. So it's when you're in the digital era, you can also see how well your acquisitions from maybe the old era will fit into your company better. And that's really the game that we're playing here, in that we're going with companies that are digital natives.
On the 4IR theme, Alec, Andre asks, have you considered investing in medical health? Anything in that sector?
Yeah, after taking a Pfizer vaccine or being given the Pfizer vaccine yesterday and hearing what the doctor said about it compared with the other vaccines, and then reading about it, I think Pfizer to me would be the one on the COVID and the coronavirus area. But no, I'm being, you don't buy a company on that basis. You just go and do your homework and find out which, if there's a reason for it. And really that's what it's about. When you invest in something, get to know the company, read the annual reports, understand what the company does so that there's no surprises down the road. Wall Street it's Mr. Market. Mr. Market is a manic depressive who's not on medication. And one day he's manic about a particular stock, and the next day, doesn't matter what that company delivers, like we saw from Spotify, like we saw from 2U, Netflix, their results were excellent from a longer term perspective. But it wasn't up to this what Mr. Market was expecting. He wanted 20% growth, and he might have got 18%. So you missed the target by 2 percentage points, smack your share price down by 20%. That's what happens. So rather you get to know the companies, you get to understand them better, and once you understand them better, you then know when it's a good time to buy. I looked at Peloton at $105 a share when Dr. Smith told us that it was 80. I looked at Twitter at $55 a share when Dr. Smith was suggesting it was a good one to look at. It was in the 40s. And then I looked back at Spotify, said, but hang on, I know this company really well. I know what they're doing. I know how well Joe Rogan's doing. I know the move that they're getting into podcasting. Daniel Ek is a genius. At 14% less than what we paid last time, to me, Twitter and Peloton have got risk issues that Spotify doesn't have. So that's what it's about. Get to understand, get to know the companies, and then you will take advantage of Mr. Market's manic depressive moods. When he's manic, you can sell, although we own these shares forever. But when he's depressed, that's when you can actually stock up.
I think Daniel Ek's only risk is he wants to buy Arsenal Football Club, Alec.
Well, Arsenal should be so lucky.
Pet just asked if you've considered semiconductor shares like ASML, NVIDIA, etc.
Yes, ASML, very much David Shapiro's favorite stock. I'm afraid that it's one of those that it's a bit like Cloudflare. I could kick myself for Tesla. You trumpet your mistakes and then you remain very much feet on the ground. David has been a big ASML supporter. The reading I've done on it, I can see why. It's just always felt a little expensive for me, but definitely, if there's a sell-off, and this is what's happening, and if you read that report that we referenced in one of the newsletters to Howard Marks, and how Howard Marks and his son had gone through, what happened was during lockdown, Howard Marks is one of the great investors, very highly respected, deep thinker, written a couple of books that are prescribed reading for anyone who wants to be serious about the subject. And he said that he was, because of lockdown, his son, who's also an investment manager, moved in with them, and they spent much more time together than ordinarily would, and they had lots of fireside chats about investing, which they're both passionate about. And he said he learned so much from his son, because his son convinced him that these are companies that you buy and hold indefinitely, and you buy the dips. Because of the seismic change in the economy, when the share prices come back, that's an opportunity to add to. There's never an opportunity to sell, because if you sell and you look back in 3, 4, 5 years' time, you'll be kicking yourself. And I can see that with the exponential companies that we've sold in the portfolio.
Isn't that with the monthly update, Alec, is that not one of the little challenges, is you can't sort of buy the dips? For instance, you mentioned Peloton. That was an opportunity, but mid-month, that's probably...
Yeah, I would have had to put Peloton in this portfolio. I'd have had to have done a heck of a lot more research on it. But again, I bounced that off a couple of the money managers who I respect. And remember, these guys do it for a living. What we do is give you suggestions to go and do your analysis on, your research on. And Peloton came out quite strongly as a positive that many of them are looking at. But at $80, sure, after it come down from 120, or $100, but now at 105, and they had really bad quarterly results. Well, bad quarterly results. What happened was that they had some
Recall,
accidents,
yeah.
on their the treadmills, and they had to recall treadmills, which cost them a lot of money. Now it's a little bit like Johnson & Johnson, what they did when they discovered that one of their products had been, some crazy guy had poisoned it. They recalled all the product all around America at that time, and they got a lot of kudos for it. Peloton are now getting kudos for what they did, rather than Mr. Market, who was very upset because it cost them money.
I know we spoke to Brian, the CEO of Hulett, last week, Alec, but Gardis wants to know if you have any thoughts on Hulett as a company. He says, as we were speaking about earlier, the share price has just gone haywire the last 2 days.
Yeah, sure. You know, Brian van Rooyen is, I've known him for many, many years. We listed MoneyWeb at roughly the same time as he listed Hulett. We love having a steak together just to catch up on old times. We're both from south of Johannesburg, so I suppose that's if you know Johannesburg, it's like living in the northern suburbs of Cape Town. And he's a solid feet on the ground entrepreneur. And when he decided to move Hulett into cannabis, he did it wholeheartedly. So he didn't hold back on anything. He went in there with everything. And if you want a cannabis play on the JSE, that's the one. But you don't have to go and overpay for Hulett. There are many cannabis plays around the world. And that's the beauty of WebTrader, is you can invest in any stock anywhere on earth. So rather than buying Hulett at a share price which is massively inflated from where it was, and it tends to do that, Hulett, it tends to spike because there are not that many shares available. So I would rather say just hold your ammo and compare it with what's available elsewhere. But is it a company that's moving in the right direction? Most definitely.
Abel wants to know, should we be looking to invest more outside of South Africa or not?
Yes, definitely. 1385, no question. So you might recall that when the rand was really weak, we decided to invest more here at home. In fact, it was in March last year that we brought percentage of the portfolio back. We bought Sasol at 28 Rand and it went to 150 and we sold. And Discovery at 67. That was a good time. Now the Rand's at 1385. The one thing we know is that if it isn't a super cycle in commodities, then 1385 is going to look like a very, very strong Rand. And the reason I say that is because the Rand it correlates very closely with commodity prices. So commodity prices have now picked up and they've really run on the restocking after COVID-19. Are commodity prices in a new super cycle? I suppose you could argue that infrastructure needs to be fixed all around the world, maybe. But what we are seeing is record unemployment lows in the US and in the UK. And when you don't have labor, and when that's getting very tight, that's not the time to start doing massive infrastructure projects, which are usually contracyclical. So in other words, usually when you need to stimulate the economy, like we do here in South Africa, that's when you do the infrastructure projects. So if that doesn't come on stream, if there isn't this massive infrastructure boom in the Western world, which looks increasingly unlikely, then where is the demand going to come from to sustain this rally in commodities? And if that happens, then watch out, Rand.
Cool. Gardis just wants to know, what about holding 18 to 20 shares for better diversification?
I'm a Buffett follower, as you well know. I even wrote a book on it. He says, concentrate your portfolio and watch it carefully.
So I see we're coming to the end, Alec, but Paul just wants to know, any views on the Chinese IT stocks like Tencent, JD.com, Alibaba, etc.?
Yeah, my view is negative on that. And the reason for that is that that Beijing doesn't like the capitalists becoming too powerful. We saw that with the way that they attacked Jack Ma. You just got to stop for a minute and imagine, in the United States, you have a company that's about to list. It'll be the biggest listing, the biggest new listing ever, the biggest IPO ever in history was Alipay. And 2 days before the listing, it gets pulled. Just remember, that's what you're dealing with here. Beijing did not like, it was their two-finger salute to Jack Ma. And what has Jack Ma, where's he been since then? Nowhere. And what have the other Chinese companies been doing? Well, a whole bunch of them signed a declaration to say that they hadn't been operating correctly and they would operate in a new way. And what is the new way? The new way is opening up their businesses to competitors so that their margins get contracted. What's happened is that that Beijing has moved from let's support our tech companies and make them global champions into no, our tech companies are too powerful. We want them to toe the line and actually not be so profitable, so that the leaders of these companies don't challenge the central government, the Communist Party. That's what's happened. So when you just overlay that, if your profit margins are not going to be supported from the state, but are going to be attacked, and especially from a one-party state as you have in China. Remember, this webinar would not be allowed to happen in China. I keep saying that because we would have a censor standing next to us. It would be delayed, and if I said anything that the party or the censor didn't want, well, they just blank you out. Like in the bad old days in South Africa, in 1985, I was working at what was then South African Associated Newspapers. And we used to have, that was a state of emergency, we would put out newspapers that late at night, so you'd produce the newspapers, they would come off stone, or sorry, before they went off stone, the lawyers would come in there and say, well, according to the regulations of the state of emergency, this and this and this and this and this can't be said. And they would literally take a black pen and blank out. So you've got newspapers of that time where the papers themselves have got big chunks of them that have been blacked out because they've been censored. We forget this. In China, they don't use a black pen. They just have a guy sitting in your media company and say, forget it, you can't say that. And you just can't. So it's a different world out there. And when the central government decides it doesn't like capitalist companies or doesn't like the companies, why are we even thinking that those companies are going to have the same type of parameters as you would have in the Western world? Doesn't make sense.
How does that influence the Naspers holding though?
No, exactly. That's what worries me. That's what should worry all of us, is that the value of Naspers is tied up in Tencent. Yeah. Tencent is trading at a massive premium to the price that Naspers is valued at. So as a consequence of that, you have to almost work out where's Tencent's future going to be and what's going to happen to that discount that Naspers is trading at. Tencent's future, you would assume, if the government wants to apply antitrust measures to reduce their profitability, then surely the share price is going to come back. The rating of the price won't be as high as it is at the moment. So what you're betting on with Naspers is that at some point in time, the Naspers management are going to realize that that's a likelihood, and they unbundle the Naspers shares. So you then get the immediate benefit of it. But eventually, those two lines will probably cross. The Naspers, its value. Well, actually, if Tencent comes down and Naspers is trading at a 50% consistent discount, then the Naspers share price would come down. And we've seen it. We've seen the way the Naspers share price has come down in the last few months. But your problem, as I said right in the beginning, about selling Naspers is that tomorrow you wake up and you see there's an announcement from them that they're unbundling Tencent, and you've just blown 30% upside.
Excellent, Alec. I think we come to the end. There's just a question to end off with. Pitt says, what is the Buffett book you refer to from time to time? Because I know there are a few, aren't there? I know you've written one.
This Buffett book you refer to. It's called How to Invest Like Warren Buffett. It's for new investors. It's written in that way. So if you're a real experienced investor, you might find it a very, very easy read. But for new investors, the whole idea is to take what I learned in going to the Berkshire Hathaway AGM for, well, over a period of about 12 years in Omaha, from reading the annual reports, from making copious notes in those 4 to 6 hour Q&A sessions that Charlie and Warren had, which were not recorded, by the way, up until very recently. Like 3 or 4 years ago, they started allowing them to be recorded. You weren't even allowed to have a tape recorder there. Or if you put your phone on and recorded it, they would actually kick you out. So a lot of it was done in that way, reading the annual reports. And I've taken much of that learning and then applied and put it into a book. So that book's available. There's still there's still copies available at exclusive books and so on, but you can get it at Amazon. It needs an update. The book was written in 2016. Other books on Warren Buffett that are really worth buying, there are 2 that stand way above the rest. The one is by Alice Schroeder. It's called The Snowball, and it is Alice Schroeder used to be enlisted by Warren and Charlie ahead of the Berkshire AGM. Remember, we got 40,000 people there, and they don't know what questions are going to be posed them by shareholders. And she would ping questions at them, almost like a practice round for the next day. That's how much they respected her. She was a top-rated insurance analyst on Wall Street. And she had this idea that she wanted to write a biography on Warren Buffett, and she got his full support. However, her biography was so good and so unbiased and so exposing that Buffett has not spoken to her since. So that was so that tells you that it's a fantastic book, even though Warren didn't like a lot of what was in there. And then the other one is by Roger Lowenstein, called The Making of an American Capitalist. And that's much more of a book that Buffett himself would recommend. It's not quite, it hasn't got the bite that Alice Schroeder's one has got. But both of those are good reads and long reads and highly recommended. And while we're talking about books, it's often said that Buffett is 85% Benjamin Graham and 15% Phil Fisher. Now, on the Benjamin Graham side, The Intelligent Investor, written by Benjamin Graham in the 1930s, is a must-read, particularly the 2 chapters, I think that chapter 8 and 13, which talks about Mr. Market and talks about margin of safety, both issues that Buffett continues to recommend. And then the other book on Phil Fisher is called Uncommon Profits from Stocks or something like that. But just look, he only wrote one book, Phil Fisher, and that's a superb book as well, where, just to close off with, Phil Fisher's son, who was also a money manager, a little bit like Howard Marks's, writes in the foreword that his father should have given up when he was in his 80s, but he carried on too long. And there are a few people who are using parallels between what happened with Phil Fisher and what happens today with Warren Buffett. But I think the difference here is that Buffett has got 2 guys who co-manage the portfolio with him, and those 2 guys are very switched on, and they've been investing in things like Apple, etc. So I would certainly not discount what the Obaas, as Yanni Mouton once told me, he described him. He said, "Nee, die Obaas van Omaha." What the Obaas has to say, it still makes a heck of a lot of sense. So there's a bit of reading matter for you.
Excellent, thanks, Alec. I know we'll end it here, but we'll be back next month, same day of the month, last Tuesday in June. And I know Business Power at 5:30 this evening for everyone who's listening. So.
Yeah, please don't forget that Power Hour. 5:30, you can get it at biznewsradio.com or and biznewsradio.com, please just go onto it. We've got easy music going the whole day. It'll keep you company in front of your desktop, wherever, or well, mostly your desktop, I suppose, just sitting in front of it and just want to listen to some music with no ads and no irritating DJs. It's all there. And then at 5:30, on comes the Power Hour, and 7 o'clock. If you miss the 5:30 show, 7 o'clock, you can get in the morning and the evening, you get the recording of it. So there's no excuse anymore to miss our show. Okay, well, that's it. Until the next time, from Stu and I, cheerio. Thank you for joining us for this webinar, which is compiled and produced by the team at biznews.com. A recording of this webinar will be available later today on the biznews.com channel on YouTube. From our team, until the next time, cheerio.